Please take your seats. The program is about to begin. Two years into the pandemic, wealth managers are finally getting back on track. But Russia's invasion of Ukraine is upending the fragile recovery, sending shockwaves through markets. Inflation is at an all-time high, and commodities are in turmoil.
We have seen JP Morgan calling even $185 a barrel oil by the end of the year.
Amid the volatility, some investors are turning to crypto for quick gains. For others, it's a digital casino.
I would say that cryptocurrencies are a bubble.
Against this backdrop, how can investors navigate the turbulence? What does the future of wealth look like? We convene leading investors, economists, and money managers to provide actionable intelligence. This is the Bloomberg Wealth Summit. Please welcome to the stage Bloomberg Businessweek Editor-at-Large, Eric Schatzker.
Hey, everybody. Welcome back. I hope you enjoyed lunch. I will be here again with another special guest in a few minutes, but right now, you're in for a treat. David Rubenstein, the private equity titan turned television star, is here to tape an episode of his show, Bloomberg Wealth, live in front of you. In this series, as you may know, I'm sure most of you watch it, David Rubenstein uncovers and explores the strategies of the world's most successful investors. You can watch Bloomberg Wealth Tuesdays at 9 p.m. Eastern Time on Bloomberg Television, of course. His guest today is a champion of both distressed investing and basketball, Mark Lasry. Mark is the CEO and the co-founder of Avenue Capital Group, and he is the co-owner of the Milwaukee Bucks. Please silence your phones, super important for this one, and welcome Mark Lasry and David Rubenstein to the stage.
So, Mark, thanks very much for making the time.
My pleasure.
Now, I was going to ask you about the fact that you normally never wear socks, but
I don't.
Today you What is the reason you never wear socks? Because they're kind of useless or what?
Useless and itchy. So, but when it rains, it's better to wear them, I guess.
Well, Einstein didn't wear socks, so, you know.
I should just continue then.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky. You've got to be really, really good, but you also have to be really lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
And let me ask you about distressed debt for a moment before we get back to basketball. Distressed debt implies that there's some company under stress usually, but for the last couple years there hasn't been that much distress. So what have distressed debt investors been doing with themselves other than buying basketball teams?
There hasn't been, you're absolutely correct. So what we've done is gone into the private lending business. So I think investors want to try to make anywhere between 10 to 15%. And so our business has dramatically shifted over the course of the last 3 to 5 years to now we just lend money. And we're lending money anywhere between 8 to 12% at a senior secured level. And then you'll do a half a turn of leverage. So it's actually worked out really well.
Well, explain this to people who may not be familiar with that kind of lending business. Normally, if you want to borrow money, you might go to a bank if you're a corporation. How can you lend money at more attractive rates than a bank, which gets the consumer deposits, which are pretty inexpensive for banks? So how do you raise money, and what kind of returns are you trying to get for your investors, and how is that more advantageous for the borrower than
Sure.
A bank?
So I'll give you a great example. We have something where we do venture debt. So there's firms are happy to invest in companies and invest, you know, hundreds of millions of dollars on a story or on an idea. A bank will never lend against that because there's no EBITDA. There isn't a cash flow. So we'll end up lending at 5% loan to value. So a company is going to raise $50 million at a $250 million valuation. We'll lend $10 million. We'll charge 12%.
So you're not lending at the senior debt level, right? The secured level?
In that situation, we actually are. There's no other debt. The real reason, you know, and in the other businesses, the real reason we're able to charge 8 to 10 or 8 to 12, look, if you can go to a bank, you are. Or you know that, I know that. If you can go borrow money from a bank, you will, because money from a bank's 2% or 3%. Then there's another group where you can go to direct lenders, and they'll charge you 5 or 6%. When people come to me, they have issues, right? They can't borrow, or they've got assets, but they've got no cash flow. And sort of what we do is we'll lend against the assets.
Okay. All right, I understand. So a distressed debt investor transforms himself into a private debt lender. And was that hard to do?
It was. You know, we hired more folks. I mean, it was something we always were doing, but I would have said to you it was 10 or 20% of what we were doing.
See, so somebody who's raised money, I can see what the pitch might be, but like you go to somebody and say, look, there's a lot of distressed debt out there, give me some money. Now you have to go to people and say, there's a lot of good lending opportunities, they're not going to be distressed, right? You have to switch a little bit.
No, that's exactly it. You are switching, and that's...
And the investors say, I thought there was going to be a lot of distressed debt, and now you're telling me it's not going to be distressed debt.
And I'll say to people, we got to wait, and we hope there is, but you're right, yes.
And do you expect, because interest rates are going up,
Yes.
and inflation is up, and the economy may be slowing down a bit, that there is going to be more distressed debt in the next 1 or 2 or 3 years than you've seen the last 1 or 2 or 3 years?
Absolutely. I mean, with rates rising, that's actually good for us because the more issues there are in the economy or the more issues there are with people, that's beneficial for what we try to do.
So, and when you make a loan to somebody, you assume it's going to come back and you're going to be paid and so forth. But when you have distressed debt expertise, do you make your loans a little bit more carefully than the normal lender because you know what it's like when something doesn't work out?
Yeah, you actually, when you're making your loans as a distressed player, you want to be always at the operating company. You want to make sure that, in essence, the company or other creditors can't move assets. You know the games that everybody plays, so you're trying to be more careful against that.
Okay, so let's talk about your background a moment. You were born in Marrakesh,
Yes.
and the reason you bought the Milwaukee Bucks, it began with an M, and you like Marrakesh, and that's it?
It was pretty much it. I thought, my name's Mark, Marrakesh, Milwaukee, why not?
Right, you like the M. So,
I like the M's.
so you're born in Marrakesh. Your parents, were they from Morocco?
Yeah, my family had emigrated from Spain, during...
1492 or
yes.
something like that?
That was exact. No, it was. We had gone to Morocco, and we had lived there. And then it was great, except Morocco had about 100,000 Jews. And there were issues that were coming, so people started emigrating out. And then we went to Paris for a little while, and then we went to Hartford.
So you were born, and what year were you born?
59.
59. So you lived there for about 8 years or so?
Yep, exactly.
And did you speak English? Was that your native tongue?
No, my first language was French, then it was Arabic. I didn't learn English until I came to the United States.
What about Hebrew?
You went to Hebrew school, but
Or that wasn't your best.
no, that wasn't.
Your best language.
I just knew when somebody.
Are you fluent in French now?
I'm still fluent in French. My Arabic I can understand. I just don't speak anymore.
Right. So your parents decided to move to the United States, and you're young. And when you came over here, did you speak English at all, or nothing?
No, not at all. I was actually. I went to a public school in Hartford, and because I had dark hair, I was with all the kids who were Hispanic. They thought I was Hispanic, so they were speaking in Spanish, and I was trying to learn. I was trying to learn English, so I was all confused.
All right. So you were a high school basketball player?
The legend is that I was, yes.
Okay. But I thought you went to Clark University and played basketball there as well.
I did, but Clark was Division III, so I played, and by my sophomore year, I realized I wasn't that good. So I then played in the club, the club teams, and I did really well there.
Okay. So, well, you weren't able to dunk the ball, I assume, though.
I could dunk a volleyball.
Really?
Well, my hand wasn't big enough for a basketball. I could jump.
My theory has always been that if James Naismith was Jewish, he would have made the hoop a little bit lower.
Probably.
Right, but okay. So, all right, you graduate from Clark, and then you go to New York Law School?
Yes, sir.
And then you started practicing law?
So I clerked for the chief bankruptcy judge. And then because I did that, I'd done well in law school. So because of that, I ended up getting offers in bankruptcy, right? I thought I was going to be a tax lawyer. I was always good with numbers, but since I clerked for a judge, and I got all these offers to do bankruptcy law, so I did that.
Okay.
And I practiced for about, it was a long time. It was about a year. That was enough for me.
All right. Well, I practiced 2 years. That was
Okay, so there you go.
yeah, twice as long. So, all right. So then, what happens is you decide to get in the investment business. And how did you segue from practicing law after 1 year into the investment business?
So I went to work at a firm. That was an investment firm, small firm, and at the end of the year, I was making $50,000, and at the end of the year, I had shifted over to the investment side, and I had made the firm $25 million. So this is in '86, and you're all excited, you're going to get a bonus. And I call my dad, and I'm trying to figure out, what do I ask? So my father says, well, don't be greedy, ask for half of 1%. So I asked for 125,000. And I thought, that would be great. And I had a child at the time. And the person who's giving me the bonus goes, well, how much do you want? I said, 125,000, I think would be fair. And he goes, no, we're not going to do that. I was like, oh, okay, how much? And I don't know if you've ever had this in your career. Somebody stands up, they put their arm around you. It's called an attaboy. You're doing really well. He goes, we're going to give you $10,000. I was like, okay, thank you. And then I left 3 months later, and I went to work at Cowen and Company.
Okay, so how did you raise your initial capital, though, to start investing?
So I went to Cowen, and the partnership at Cowen gave me $25 million. We did about 60% a year for about 2 years. And somehow I got on the radar of the Bass family and somebody who you know, David Bonderman. And they asked me to come over and run money for the Bass family. And they gave me $150 million to manage. And we did really well for them. And I did that for a couple years. And then in 1990, I left and went, I was 30, so I was old. And I left to go off on my own, and I started investing my money. I had made with the Bass family about $10 million. Okay. So I gave my wife half and said, never give me this.
So what company did you start then?
I started Amrock. And Amrock is, if you switch the A and the M, it's Maroc, which is Morocco.
Okay.
Right? And so we started that, and we invested our own money. And we sort of doubled the money every year for about 5 years. And that's how I started Avenue.
Right, now where'd you get the name Avenue? It's a clever name, right? How'd you think of that?
Well, we didn't have a name.
Okay.
So we were on Madison Avenue, so I called up our lawyer. And I said, Madison Avenue Partners. He goes, that's taken. I said, Lexington Avenue. He goes, that's taken. First Avenue, that's taken. So I said, all right, just hold Avenue. Is that taken? He goes, no, nobody calls a firm Avenue. And that's how we got it. And then when I told Bonderman that, he was like, oh, I love that name, because you want a name with an A, so then when they list funds, you're the first one. I was like, oh, okay, great, we'll stick with Avenue.
So you started the firm with your sister.
Yes.
And it's very unusual to see brother-sister financial partnerships, I guess. I don't see that many of them. So what's it like working with your sister?
It's actually great. It's, I think you can only work with a sibling if you're really different. I think when you're similar, it's very hard because you want to do the same things. I think when you're different, she manages the firm, she's general counsel. She is focused on making sure the firm runs well. I end up getting to do the investment side, which is what I love, and the marketing side. So the things I love, she doesn't, and things she loves, I don't.
And you have another sister in the business?
Yeah, we have one more sister who out of the three of us is probably the smartest one, but she joined 10 years later.
Oh.
So
Do you have any more sisters in our company?
no, that's it. I just had
Okay.
two sisters.
And all right, so you're managing money, you're doing pretty well, and then you go out and start raising third-party money, I see.
Right, yeah.
And so today, how many dollars do you have under management? What's your AUM?
We have 12 billion.
12 billion. And how many employees do you have?
About 175.
And so you're mostly focused on the private lending business. You don't do distressed debt right now because there's not that much to do.
Right.
And eventually you're getting ready for distressed debt.
Yeah,
Okay?
we'll be doing it.
And to be a good distressed debt investor, you have to be litigious. You have to be able to yell at people and say, I'm going to sue you, I'm going to take you into bankruptcy court or something. Is that what's required?
Yes.
Okay. All right. You say, I worked for the bankruptcy judge in New York. I know bankruptcy. Is that what helps?
Yeah, I mean, my style is, I'm pretty simplistic about these things. I'll explain to people, I'm like, look, here's what the law is, here's what we can do. I have a lot of leverage. Don't force me to use that leverage. Let's try to cut a deal that's fair. And I think most people want to do that. It takes time, and sometimes you actually do have to sue, and you have to be willing to sue people. Right. And if you're willing to do that, and we've done it in our career, then people understand you're willing to do it. So I think most of the time it's a compromise.
Okay, so you're very laid back. You can see your dress style. You never wear a tie, right?
I've worn it when I went to the White House, but other than that,
Okay.
no.
So how did you get this laid back style? Is that from Morocco or just your personality or what?
I think I got the happy gene. So it's just, it's all good.
Right, so you're managing your company, your family's money, you've got 2 sisters, everything is going well. Why did you want to buy a basketball team?
I wanted to buy a basketball team at the time because I had played. I loved it. I thought it was fun. I was about 52 years old. I wanted, we wanted to try to do something with the family because my kids all played basketball. So the Milwaukee Bucks came up. That was the good news. The bad news is they were in Milwaukee. So it was a bit far to go, but they were the only team, and so we got involved, and we were able to buy it.
Were you bidding against other people?
We were. We actually were. I think we were $100 million over. Somehow, you hate when you find out that you outbid.
You were prepared to pay $100 million more than the next bidder?
No, we found out that the next bidder was at $450, and we were at $550.
Oh.
And
so did you lower yours to $451 or?
I wanted to, but they said they wouldn't accept it. I was like, I don't understand. We're $100 million over. Why can't? How about $500 million? They were like, no, it's $550 or you don't have it.
So what did you do?
I caved. I shouldn't have, but I did. And
but the team is now worth over $2 billion or something.
yes.
So it's a pretty good deal.
Yeah, it's so the part that's actually shocking when we bought the team. It was making $5 million, so we paid 100 times. So today, you invest. If I said to you, hey, 7 years later, the team's going to be losing $5 million, what do you think it's worth? You wouldn't have said $2.5 billion.
So when Steve Ballmer came along and paid $2 billion for the LA Clippers, I guess everybody in the league was happy, right?
Oh, I was thrilled, yes. I thought it was the greatest thing. I was like, yes, good trade.
So today, you have the most valuable player, I guess, in the NBA.
Yes.
And did you personally recruit him or scout him or not, something?
I wish, because then it would be a great story. He was on the team. He was a rookie when we were buying the team. So he ended up, we met with him when we were doing our due diligence, and he was literally 50 pounds lighter. He was this skinny 6'11" kid, Giannis, and had the greatest smile, just a happy guy. And we started talking about, I was born in Morocco, you're born in Greece, we both came to the United States. And he was just a great guy.
But he wasn't that great until you came
No.
along, right?
Yeah, we made it, yeah.
So when you ever do workouts, you used to play basketball, do you ever do workouts with a team?
Yes.
And you dunk the ball with them or you just?
No. I'll give you a great story. When we had bought the team, and I was with all the players, and one of the players, I was kidding around with him. I was like, why don't you and I play one-on-one? And he goes, sure. And I said, we can play for a whole bunch of money. And he goes, okay. And I said, here's the rules. I have to score 1 basket. I get 15 tries. You don't need to score because we know you'll be able to score. And he says, okay. And I said, well, just want you to know, I played in college.
He said, what college?
No, he didn't even say that. It was words. He goes, well, I just want you to know, I play in the NBA. I was like, oh, yeah, it's good. And so I said, all right, let's play. And he goes, just so you know, you're not going to be able to score. You're not going to be able to do anything. It's going to be really embarrassing, and everybody's here, and everybody's going to watch how, horrible you are. I said, are you serious? You don't think I can? He goes, no. So I actually didn't play him because I was so worried. So we played horse, and that's what I'll do with the players. I'll play horse. They just can't jam. They can't take threes. They've got to shoot within 10. I have all these rules to make sure that I can win. So
what happened?
Oh, no, that I can win. On horse, I can win, as long as they follow my rules.
But when the team is not doing that well, would you ever go in and give a win one for the Gipper speech at halftime? Do you ever go in and kind of tell them win one for the owner?
No, that I don't do, but I will go in I have a pretty good relationship with a lot of the players, so I'll just go in and say, look, you stop worrying about it, just shoot. You don't. It'll go in. If it doesn't, it's not the end of the world. We'll lose and we'll all go home. But it's just more cheering people up. It's a lot of fun. We have a player, Chris Middleton, had a bad game, so I went in the locker room and I was kidding around with him. I was like, look.
Well, so one of your best investments has obviously been the basketball team.
Yes.
Are you thinking of buying any more sports teams, or?
No, they're expensive now. They're very expensive.
Now, recently I think I read that you invested in a sports betting app.
Yes, Lucra.
Now, tell me why you're involved in that, and how much can owners of NBA teams invest in sports betting things?
Yeah, no, you can. You can invest in a lot of things that the NBA is involved in. You just can't control it, so you can be an investor. So I invested in that. I actually bought another franchise. I bought a pickleball franchise. So have you ever played pickleball?
I've heard of it, but I haven't played it yet. But
It's
I
like
didn't know there was a franchise you got. I thought it was a sport you just played. But
You play it.
they're
So
teams?
they just started a franchise. And they just started a league, pickleball league. It's like the fastest growing sport, and I play it all the time just because it's easier to play. But then a friend of mine, James Blake, said we could buy a team, so I bought it with him.
Wow. So that was less than $550 million, I assume.
Yeah, it was less. Yeah, it was less than $1 million.
So they have like sweet pickleball and dill, or what? So just not that way. No, they don't do that. So let me ask you: your son has been managing the team for a while. Is that right? Or
He was working for the team, but now he's running for the U.S. Senate in Wisconsin.
okay. And you've been interested in politics for a long time, and obviously
Yes.
you've backed a lot of politicians. I think most of them are Democratic.
Yeah.
When you hang out with politicians, what's the fun of it? You knew President Clinton pretty well, President Obama. What's the fun of hanging out with them? Or that you play basketball with President Obama?
I didn't have the opportunity to play basketball with him, but I think I love meeting people, and I think it's actually great. When I've been with President Clinton, I've gotten to meet. I've gone to Davos with him, so you meet world leaders. So for me, it's meeting people that I normally wouldn't get to meet. So yeah, I think it's fun.
Hey, but you're not running for office.
No, I'm not.
You're never going to do that.
Never.
Okay, so let's talk about the government, though, another part of the government. You're an expert in debt investing.
Yes, sir.
And you like distressed debt investing.
Yep.
The U.S. government has like $30 trillion of debt
Yes.
that some people might say sort of distressed. Are you worried about the U.S. government's ability with higher interest rates to pay off this debt without deflating the value of our dollar?
Yes, I actually am. I think that's going to be an issue. I don't think anybody's going to focus on it. They'll start focusing on it in 3 to 4 years. I mean, as rates move up because of the debt that we have, the cost of servicing that debt is so expensive. It's going to be an issue, but for whatever reason, people don't want to focus on it.
But do you buy government securities or debt around the world? Do you buy debt in other countries?
No, we don't. It's got to be a company because we've got to be able to do the work. I think when you're buying government securities, that's a macro call.
But the general economy itself, now as we talk, there's a war in Ukraine. Is that affecting the economy in your view? And are you worried about the economy and a potential recession?
I think it's obviously creating issues. I think as oil prices move up, the cost of that for the consumer becomes higher and higher, obviously, and that'll create, I think you could have a recession. I think right now we're probably growing at 1 or 2%. But if things slow down, I mean, the Fed is raising rates, oil's going up, we'll see where things are in 3 to 6 months. But you could be in a recession. I mean, a recession is 2 down quarters, so it wouldn't be till next year. But I think things are definitely slowing down.
So do people in government, there's a Democratic administration now, you're well known to a lot of Democratic figures. Do they call you for advice, or do you go down there and tell them what to do, or how does that work?
Yeah, they'll call. I go down there, and the great thing is they don't listen. So it's actually, I don't know if you've ever found that, but you give your advice and people go, oh, thank you, and then you leave.
What about members of Congress? Do you talk to them very much about what's going on?
I'll talk to some. I will, but I think part of it is, I think there's a view that you've got to keep on spending, and that you need to do that. And I don't know if I disagree with it, but it's going to create a lot of issues.
So when you're not distressed debt investing or lending money or talking to government officials or doing basketball, what do you do outside? You have any hobbies? Do you keep in shape by playing basketball, or what are your outside interests?
I love playing tennis. So I play tennis 2 or 3 times a week. I love playing chess. So I play chess online. So I got to meet my childhood idol, Garry Kasparov.
Do you play him?
Yeah, he wouldn't even play me. I mean, he asked me what my ranking was. I told him, and he started laughing. So I doubt I'd play him.
But why can you, if you're playing online, can't you get a computer to help you and they wouldn't know? Or
Yeah, it's cheating. Why would you cheat? No.
you could say you beat him. You wouldn't do it. Okay.
Yeah.
All right, so you don't do that. So chess, tennis,
Yeah,
or what do you?
and basketball I love. I now, we have 5 kids, so we have 9 grandchildren now, so I'm trying to teach my grandchildren how to play basketball. So on weekends we have a blast. It's a lot of fun.
And what about philanthropy? What are your philanthropic interests?
So, I went to college on scholarship, and same thing, law school. So I'm a big believer in trying to give back to schools, because I think education's a big thing. I wouldn't have been able to have done what I did. So I'm focused on, trying to create scholarships and things to that effect where I went to school or my kids have gone to school.
Now, if somebody says, I want to be the next Mark Lasry, I want to be a great distressed debt investor and own an NBA championship team. I don't know whether they want to do the former or the latter, more probably the latter, but let's suppose they want to be a distressed debt investor. What do you advise people to do to get trained to be an investor? Is it just do well in school, be good with numbers, be willing to litigate? What is it that you need to do?
I think it's a mixture of everything. I think you have to do really well in school. I think that's number one. I think you have to be really good at numbers. And then I think you need training. And, whether that's going to work at a firm like yours or Goldman or Morgan Stanley, have like 2 to 3 years where you're in a program. And then, I think we like to hire people after they've had some sort of training for 2 to 4 years.
Okay. So you seem like you're a fairly laid-back guy. You're dressed very casually and so forth. But I always thought distressed debt investors are very nervous people. They're pounding on the table. You don't have that characteristic, or you'd have somebody else do that for you?
No. I think people are usually pretty smart, so I like to explain what the situation is. And I think when we talk to people, we'll say, look, here's what you can do, here's what I can do. There's a 90% probability I'll win, but there's still 10, so I'm willing to settle. I just sort of try to go through all the facts with everybody. I think other people, I've had folks, where they'll come in my office and say, if you don't agree to this, we're going to sue the shit out of you. We're going to make your life utterly miserable. And you'll go, okay, all right, good luck. I guess we're going down that road. I mean, I don't take it personal. I think I know what will end up happening, or I assume I know, and there's a probability of that. So I just focus on things I can control, not things I can't.
So have you ever made a distressed debt investment, didn't work out, you actually lost money? Does that ever happen?
Yeah, it's horrible. Yes.
So what do you conclude was the mistake you made? You're just too optimistic about something?
Well, I think that the business itself changed. We thought we were covered on the debt side. And then what normally ends up happening is the company needed more cash, so we let the company borrow against that because we didn't want to liquidate the company, and just, we were wrong. And I think in investing, you're going to be wrong a number of times, but you've still got to take the risk, so that's fine.
So when you lose money, it's pretty depressing. You just go on to the next thing, or do you think about it for the next 30 years as I do whenever I do something else?
I don't think about it for 30 years. It's probably after a couple days, I'm over it. I mean, it's.
What about your best deal ever? Without mentioning the name of it, perhaps you don't want to embarrass anybody by saying how profitable your deal was compared to what they did, but what was your best deal? Was it make 5 times your money, 10 times your money, something like that?
I think our best deal for us was something where we made 30 times our money, where we had bought the bonds at 2 to 3 cents, and the bonds ended up becoming worth par. So that was great.
You have any more like that?
I'm looking for them. Trust me, they're not. Those we did in 2008, 2009. So
So let me ask you this. Sometimes I have friends in the distressed debt business like you, and they don't like to say this to me, but let's suppose my firm does a buyout. And they actually don't want to tell me, but they think it's not such a good buyout, and they start buying my debt at a distress. Do you tell your friends in the buyout world, guess what, I think your debt isn't going to be so great, and I'm buying it now at distress because I think you're going to go bankrupt? You ever tell your friends that?
all the time.
And what
I've
do
gotten
they tell
no
you?
calls. Yeah, I mean, I'll say, look, you own the equity, I own the debt, so I think I'm senior. Your debt's trading at 60 cents, so theoretically your equity is worthless. And they say to me, no, actually, you don't understand what we're doing. We're going to turn around. I'm like, so why don't you buy the debt? I go, are you kidding me? If I'm right, I wouldn't want to go from 60 to par. I've got the equity. That equity is going to be worth 5, 10 times. You know, everybody, I think as a credit investor, I'm very happy making 2 times my money or 1.5 times.
When you've seen debt at 50 cents on the dollar and you buy it at that price, does the equity ever go back to par?
Sometimes it will, because our debt will go back to par and then the equity's worth it. You've seen it actually in the last 2 years in almost every oil services company. I mean, that debt 2 or 3 years ago, energy prices were down. You could buy the debt of a number of these companies. Today, that debt is gotten paid off and the equity of these companies has gone through the roof.
Sometimes distressed debt investors or credit investors, they're focused on a screen all the time, I would say, the Bloomberg screen.
Yeah.
So do you spend all your time looking at Bloomberg screens, or are you kind of more laid back and have other people do that and you just kind of occasionally look at it?
No, I sit on the trading floor. I look at my Bloomberg screen. It's there, but I'm not focused on prices every second. I like to sort of see what's going on within the market, understand what's happening, talk to our trader. You know, in 2008, we were buying Ford, so Ford bank debt. And we started buying Ford bank debt at 80 cents. Then it went down to 70, 60, 50. And we had like $500 million of it. And our trader, you know, I'm sitting right there and he goes, do you want to buy more? And the analyst and the PM are near me and they go, we should. I said, I don't want to own any more of this. We own way too much. And the trader says, well, we're locked in. We've got to sort of bid on it. I said, great, just bid 30. I don't care. He goes, Mark, they're not going to do anything at 30. So I said, okay. He bids 30. You hear him say thank you. I'm like, why are you thanking the guy? He goes, well, we just bought it. Like, oh, my God. Now, the worst part about buying something at 30 is the other $500 million you now have to mark down 20 points. So we just lost $100 million. And look, it went on, but ultimately Ford bank debt, you know, it was worth par. I mean, we got paid back par. But in all these things, I try to focus on, hey, where are things 6 months from now? I'm not trying to focus on where something is today, this second.
Let's suppose I say, I don't really know much about the investment world. I want to double my money over the next couple years. Would I be better off to go into a buyout firm or a distressed debt fund?
A buyout firm. I would. I mean, I think because I'm going to be limited. My average cost is usually 60 to 75 cents, right? And for it to work out, it's 2 to 3 years. A buyout, when you're right, you know, you'll make 2, 3, 4, or 5 times your money because of the leverage.
Okay. So what is the best investment advice you've ever received?
Wow. I think part of it was from David Bonnerman. It was like, when you make a mistake, just move on. Don't learn from your mistake. Don't focus on like all the things you did wrong. You're gonna make mistakes. Understand that, make your mistakes, because the only way you will ever make money is by taking risks. And I think in the beginning I was a lot more conservative, and I've become a little bit less conservative because of that.
I wish I'd had that advice. I focus on my mistakes for about 30 years, then I get over them. But what do you think is the biggest mistake that the average investor makes? Is it selling too soon or not going with the right group? Or what do you think the average investor's biggest mistake is?
I think the hardest part is giving money to people who don't know what they're doing. I mean, I'm always amazed at that. I'll always meet with people I went to high school with or college, and I'll ask them what they're doing with their money, and they'll tell me, I'm like, oh my God, I would never do that. Like, put it into a fund or do this.
What about your basketball players? I mean, basketball players aren't famous for being great investors, I don't think, but maybe yours are good.
No, it's the same thing. I mean, you would be shocked. It's exactly what you said. So I spent a lot of time with them explaining where they should invest. You know, Giannis had a great line. He was at our house one day, and we were talking about investing. And he said, he goes, where do you keep your money? I said, well, my money's at JP Morgan. I go, where do you keep yours? He goes, oh, 50 different banks. I was like, what do you mean 50 banks? He goes, 50 banks. Because you have, I do it up to the insured amount. And so I got to make sure my money's insured. And part of that is because he's from Greece. He was worried about banks going under. I'm like, Giannis, you can't be like having accounts at 50 different banks. Like, let me tell you something. If JP Morgan goes under, your little dinky banks are going to go under too. Like, let me explain what you should buy. You should buy U.S. Treasuries. You should buy this. And it actually was fascinating. Just, you've got to spend time with them for them to understand all this.
So in the remaining half a minute we have, what is the greatest accomplishment you're proud of, and what is the greatest pleasure in your life today?
Oh, I would say my biggest accomplishment is my kids. I think I am so proud of them that, when I look that I came to this country as an immigrant, that my son can run for the U.S. Senate. I think my wife has done a phenomenal job in raising our children.
What about you? Didn't you raise them too?
I did, but I live for my kids. That's it.
And the greatest pleasure of your life today is your grandchildren, your children?
It's my children. I would tell you my children, my grandchildren. I get so much joy from that.
And you think you can repeat as NBA champion?
Oh, yeah, absolutely.
All right. Well, thank you very much for an interesting conversation.
Thank you.
Please welcome to the stage Global Head of Private Wealth Solutions at Blackstone, Joan Solitar, with Bloomberg's Eric Schatzker.
Hi again, everybody. I am Eric Schatzker once again, and welcome to the Retail Revolution Comes to Alternatives. Blackstone, it is fair to say, is leading that revolution, and that is largely due to the efforts of Joan Solitar right here. She is the head of Global Private Wealth Solutions. Joan, I remember, I've relayed this to you before, so she's not going to be surprised, but it's okay.
I can act surprised.
I remember Steve Schwartzman, for the record, her boss, more than a decade ago saying there was no good reason that people shouldn't have private equity, which was, to a large degree, Blackstone's focus back then. There was no good reason they shouldn't have private equity in their 401ks, and he predicted that someday, eventually, it would happen. And we're not quite there yet. But was he right? Will it happen?
I think it will happen because the premise of saving for 10, 20, 30, 40 years and only having access to daily liquidity product doesn't really make sense. It's a mismatch. It's not how you would invest a foundation, an endowment, a pension fund, which is saving for retirement as well. So I do think it will happen, but I don't know when.
And to be clear, the underlying principle, that I know everybody gets this, but we should say it for the record, the underlying principle in that calculus is that you are giving something up in exchange for the liquidity of a publicly traded stock or an easily accessible fixed income instrument or fund, such as a mutual fund, correct?
Correct. So if you think about it this way, or just even, it doesn't even matter if you're talking about 401k or just your investments generally. there's some portion of it that you won't need to access in a day's notice. And there's some portion that you'll want to be able to access in a day's notice. And so I don't think anyone would suggest that 100% of your investments should be completely illiquid. But somewhere in there, alternatives should be a core part of your strategy rather than this thing that's hanging on the outside.
Now, is the definition of alternatives any different for this, this base of retail investors than it is for institutions?
It isn't, but it comes in different packaging. So the way I would think about it is as follows. You have what are called drawdown funds. And so we'll use private equity or growth equity as examples, where you're making a commitment, a 10-year commitment. And the fund manager will invest your money over, say, 4 or 5 years. And when those investments get sold, you get back your capital and the gain. Those are only, even today, accessible to the ultra high net worth. So qualified investors categorized as 5 million or above. But the vast wealth, not just in the US, but everywhere around the world, sits beneath that. And the alternative investments that are now accessible are what we call semi-liquid. So they have quarterly liquidity. You can invest in them continually. And that has just changed what's happening in the alternative business. It's increased accessibility. And I think that's been the big defining moment upon which advisors have really started to embrace alternatives.
I think it would help a little bit if we clarified or at least defined exactly what Private Wealth Solutions is at your firm.
Sure.
What part of the industry it is more broadly, and also where it fits inside the company.
Sure. And maybe this is helpful. So Blackstone's a bit unique in that we're not just the largest alternative manager, but we really have scale businesses across the entire landscape. So real estate, private equity, infrastructure, private debt, hedge funds, life sciences, growth equity. And within private wealth, what we've really done is take institutional quality investing and brought it to individuals everywhere around the world. Our clients, by and large, are financial advisors, relationship managers, who then are advising their clients. So we're distributing mostly through other firms. But we run it not as a sales organization, which I think would have been a mistake, but an end-to-end business. So it's creating bespoke structures that just work well for individuals versus institutions, and providing a lot of education, because even today, probably 80% of advisors have never allocated to an alternative fund. And then we've developed a big investor servicing arm at the back end, because it's not like buying a stock or a bond. There is more, a little bit more to it.
Why is there reticence on the part of advisors when it comes to allocating to alternatives?
Well, to start with, I think anytime you call something alternative, it feels and sounds a little bit foreign. But if you think about it, you've been an advisor for 30 years. These are relatively new structures. They're unfamiliar. And I think there's a big educational lift. And so that's happening. And every week, every month, we're seeing an increase in adoptability, but it's just going to take time. So if I think about the biggest firms, and whether they're in the US or Europe or Asia, it doesn't really matter. These numbers are probably pretty consistent. The penetration of alternatives today is still below 5%. But their top-down CIOs are recommending somewhere between 15 and 20%. So there remains still a massive gap. And the product is available. So you have to close that educational gap. You have to make sure the technology works. You have to have the investor services arm. And all of that is evolving real time.
One of the reasons, perhaps, that advisors and their clients are apprehensive about investing in retail alternative products is they either wonder where they stand relative to institutions in the pecking order. Are they pari passu? Or maybe they even have some doubts about that. They think, well, if I buy BCRED or BREIT, Blackstone's institutional clients are going to get all the good stuff, and I'm going to get everything else.
Yeah, I think that's why you have to really be careful around manager selection. Trust is paramount. So we all think certainly investment returns are the #1 factor in manager choice, and certainly they're important. I mean, for me, the fact that all of our products on the retail side are built off of the backs of long-term positive performance, that's great. I'm glad that I have it. But it's really the trust, the consistency, the transparency over time that builds your moat and builds your franchise. And so I think that's what we've done. I mean, we've now been at this for more than a decade. And so advisors and investors have had that proof of concept with us. And importantly, you mentioned 2 areas, private real estate and private debt. And in each case, these are the same teams. You know, we don't have
Are they
like
buying the same things?
So they're not buying the same things, but they're not lesser than. I'll explain. In real estate, it's core plus, which means there's a bigger yield component because that is what the individual investor wants, and a smaller gain component. The institutions have preferred the opposite, which is they want the bigger opportunistic gain, and they don't care that much about the yield. So it's really tailored to what the individual wants, but the quality is incredibly high. And so it's the same sector selection, whether it's multifamily housing or logistics warehouses or build-to-suit offices for biotech companies. And I think that's critical as well.
Joan, one of your colleagues reminded me just how much the retail business at Blackstone has grown since you and I talked about it last, which was about, hard to believe, but there was a pandemic in between 3.5 years ago. The AUM in private wealth solutions has roughly tripled to almost $200 billion.
Yes.
And retail now accounts for some 20% of Blackstone's inflows. Let's talk about that trajectory. We know where it came from, a smaller base. Where does it go to from here?
Oh gosh, I think we have so much room to roam. So it's interesting, around the time that you and I spoke, I had said I thought we could get to $250 billion over the next decade, and we will reach that point, you know, well before the 10-year mark. But when I said it, I think folks looked at it a little, you know, like, oh yeah, you know, good luck to you. But now when I say I think we could go from 200 to over 500 billion, which is what I believe, there's less surprise now that we have critical mass. So, you know, as I mentioned, we're talking about global wealth markets that are trillions and trillions of dollars, and these are not new investment funds, but they're new to the retail market, and it will take time.
Do you see a point when, again, I'll use it and I don't mean it pejoratively, retail becomes half of the funding mix at Blackstone?
I mean, there's no reason that it shouldn't, meaning that the pie is as large. And you know, you alluded to what Steve said about 401ks. Well, I would say the same thing just about any investment portfolio. I think let's just take today's environment where everyone's worried about rising interest rates and inflation, and lots of folks are still sitting on big fixed income portfolios, municipal bond portfolios, or cash. None of those will do well in an inflationary environment. And so migrating into alternatives where you have floating rate debt, or in real estate where you're invested in sectors that should outpace inflation and provide protection. I mean, we're starting to see that shift. And I think these are just important core elements of anyone's investment portfolio.
Why did it take so long? We know, of course, that dating back to KKR in 1976 or Blackstone in 1985, alternative investments have been available to institutional investors and then subsequently high net worth investors. Why did it take so long for the retail channel to develop?
Yeah, it's really interesting. I mean, when I go back, I joined the firm in 2007, and the only money that we invested on behalf of individuals was really like friends and family. It was less than 5%. But it really was the next year, 2008, that we started talking about diversifying where funds were coming from. So by and large, the biggest investors were US pension funds. And today, while they're still a really critical part of our investor base, you have sovereign wealth funds, much more diversification around the globe. And as we were saying, there was really no reason individuals shouldn't, other than they didn't have access to it. And what we found when we did the research was, we were not even set up at that time to really serve the advisor. So it wasn't just enough to just offer the product, and I still believe that. I think having the ability to provide education, marketing support, investor service support is really what you need. And along those same lines, I'm often asked, well, how come your competitors took so long to try to emulate what you're doing? I think it's very easy to look at a market and say, well, they don't buy alternatives. There's no business there, right? That's one way to look at it. Another is, that's why there's an opportunity. They should. And if we can build the better mousetrap, let's do that. And I would say the same internationally. It's easy to look at Europe even today and say, oh, Europeans don't invest in alternatives. Yes, that's why I'm interested in building out a big European business, because they should.
And maybe they will.
And I think they will.
What are some of the challenges, Joan, of managing a business of this scale and managing growth at this pace?
I think the challenge always in really scaling up is you want to make sure that the adherence to excellence in everything you're doing is felt by every single person on your team, even the new folks. So spending a ton of time around training, around culture building. I now speak at all of our, we do a week-long training session in our business every single month now, because we have so many people joining. I don't want to wait a quarter. And I speak at all of those, give them the history of the firm, the vision of our business, and I spend a lot of time on culture. Because I think we can train you on all of the technicals, but I want to make sure that the people we're bringing on are hardworking, that they're curious, that they carry the highest standards of excellence, that they understand that we are collaborative, and that we care about everything we do. It's not enough to just provide good investment performance. How we treat clients, how we think about product structure, it's all to have an excellent experience.
How many people do you employ?
So today we have about 260.
And growing how quickly?
So we probably added, I don't know, over 60 just so far this year.
Boy. We talked about the products that you currently have, Core Plus Real Estate, Private Credit. One's called BREIT, the other's called BCRED. BCRED is, how much is BCRED pulling in a month?
I don't know that I'm allowed to actually say that,
well,
but maybe I am. I'll say this. The perpetual products, and we can talk about the products that we offer every month, we're raising between $4 and $5 billion a month globally.
Month. What's next in terms of product development? Where is this going? I mean, should we make the assumption that Blackstone will have a retail product to match every one of its institutional strategies?
There's certainly more to come, and I'll share with you when I hired our head of product development, and I told him that we should be creating something really category killing every year. he said, I just looked at you with disbelief, but now that I've been at the firm for over a year, I think we could do more than that. We have so much to pull from. So I think you'll see growth in two areas. Certainly from other of the private equity type investing, because as you mentioned, we have the private credit and private real estate. And then you will see more bespoke regional extensions, so around the world. Because what we found, and we can really do with our scale, is what works in the US may not work equally well even in Canada or Japan or wherever you are. And so we're continuing to tailor the structures as we move around the world.
Can you think of anything that is not suited to retail participation?
So this is what I would say, rather than some wholesale, asset class, you have three parameters that you want to think about. You have liquidity, you have risk, and you have return. And so one, it's a question of what is your return threshold? How much illiquidity can you take? And how much volatility do you want to take? So that's how I would think about it.
As we've established, the way that you distribute these products now is through networks of financial advisors. Wirehouses are a big channel. Going back to where we sort of started the conversation, can you see people buying these products or products like those directly? Self-directed 401ks, Schwab, Fidelity, that kind of thing. Is that where this is going? Because, and I just want to add one point,
yes.
And it's important for people to understand this, depending on which class of share you buy, it can be expensive to get in.
So I would say even on that, at least as it relates to our products, and this is why I think, again, manager selection is so important. We've designed our products to take into account what the brokerage fees will be. So we think about the net return. And if we think the net will be too low, we just don't launch that product. There are differences depending on your individual arrangement with your advisor, whether you're in a fee-based account or a brokerage account. So definitely different fee structure. Whether you'll be able to ultimately buy alternatives more broadly on electronic platforms, I would imagine that over time, they will become more available, just like stocks and bonds became more available. And you as an individual will have a choice whether you want to be a do-it-yourselfer or, as it relates to your portfolio, whether you want to have an advisor. I would say even sophisticated investors often still have advisors for portions of their portfolios. But I think the technology will get better and better and better. And so I would imagine that some portion of alternative distribution will ultimately be technologically driven.
Going back to what we said earlier, the promise of alternatives is that you're getting something superior to what you might be able to get in a comparable public market. Does it not stand to reason that the more money that goes into these kinds of vehicles, again, $4 to $5 billion a month is not small, and you're not the only firm in the game, that return advantage erodes over time and the product becomes more commoditized and more like what you can get in the public market?
I guess I would take exception to that by looking at the history of our asset classes. So when Blackstone went public in 2007, we were managing $88 billion, and today it's probably tenfold that. And the returns have not diminished, even though the firm has grown tenfold. And I would say scale is our advantage. In public markets, what you're saying is exactly right. If I'm trying to buy $2 billion worth of a stock, I can't do that without moving the stock. But if I'm trying to buy a $20 billion company, I'm going to have very few competitors. So that's really what we've done. And interestingly, one of the advantages we have in our expansion in the retail business is we've just widened the aperture of everything we're looking at. So when you talk about are you being disadvantaged as a retail investor, I would argue whether you're a retail investor or an institutional investor at Blackstone, you should just know we literally see almost everything now. And so, I don't, if you look at the returns of the latest funds and, check out our 10Q, you can see all of the funds. They're certainly no less than the earlier. So I don't think that's actually been borne out.
Joan, we could keep talking. I'm afraid we can't. The retail revolution isn't just coming to alternatives. It very much is here. Thank you very much.
Thank you, Eric.
Ask everyone to join me in thanking Joan Solotaroff.
What could be more important than telling stories where everyone has a voice? That's not just good journalism, it's a responsibility.
The intent of the New Voices program really is to improve our coverage. And in early 2018, we decided to do a real analysis of our guests on TV and quotes in our stories. At that time, only 10% of our outside guests being brought onto TV for interviews were women. We knew that we really needed to do something intentional to change that.
The challenge is that a woman spokesperson who are usually as good and as able and have as much potential, they tend to get overlooked. And I think this New Voices program exactly addressed that challenge.
I was really driven to appear on TV because I am a big advocate for women in investment management, and you cannot be what you cannot see.
What have you thought to yourself about how to potentially participate in that kind of wealth?
It's a great question. So I think we at Florida A&M, to be able to be heard, I think is one of the best gifts that you can give anyone, whether it's heard on TV, heard in life. So the fact that the New Voices program allows people to be heard, I think it's just phenomenal.
Women just need a push, they need encouragement, they need the skills, and we can help them do that with the New Voices program.
We decided we at Bloomberg could sponsor intensive media training for senior female experts in cities around the world to not only address the gap that they were facing, but to also help us identify and discover new qualified female experts.
The reason why I think the New Voices program is so important is that it really empowers women. Yes, in media, but also in their jobs, in their careers. It gives them a platform. It gives them a voice.
After I came out of New Voices, I was able to give concise responses, crisp responses, and responses that really communicated what I wanted the audience to know.
If you put your mind to something, push your boundaries a little bit, get out of your comfort zone, anything's possible.
We started this program with 10% representation of outside female guests on Bloomberg TV. We tripled that within 3 years, and we want to keep pushing for the betterment of our coverage, for the betterment of the industry going forward. We're constantly expanding the program because that was the intention from the start. We named this program New Voices because we didn't want to restrict it to gender only, and we certainly didn't want to restrict it to the United States. We've also added cohorts of Black executives of all gender identities in the U.S. and Latinx executives of all gender identities in the U.S.
After receiving the media training for New Voices, I really felt like I got more skilled in being able to provide the answers and provide the insights that I wanted to give.
It gave me agency in being who I am.
I think I've grown more confident as a person to express my points of view. I think it's also important for the financial services industry to be able to see me represented, to be able to see people like me represented, and to know that I do have a voice.
Every week we try to do better than the week before. More female leaders given more time on air, more space on the airwaves.
And this kind of work is not one and done. You know, it's very easy to slip backwards. It's very easy to lose focus. And hopefully, if we stay focused, if we stay intentional, we actually will see real change.
Please welcome to the stage Bloomberg's senior executive editor and New Voices founder, Laura Zelenko.
Hello, everybody.
Good afternoon. So we're so proud of the progress that we've made with our New Voices program, and I want to assure you that we are not letting up. We have tripled the representation of female experts on Bloomberg TV since 2018. We are setting an even higher goal this year, and we are expanding to more cities. We're going to be adding Zurich and Tokyo to the list of cities where we sponsor this media training. Now, we do this work because it matters so much to our coverage. Diverse sourcing makes sure that we are fair and balanced in our coverage. It helps limit our blind spots. It helps limit our biases. And it ensures we tell all the stories that need to be told. I've been a journalist at Bloomberg News for almost 30 years. I started by opening up all of our offices in Eastern Europe and Russia, and then I ran big global teams of reporters and editors covering everything from finance to business to markets. And I am certainly aware of why it is so difficult for some journalists to diversify their sourcing, especially when they're on deadline, and particularly when the main industry that they cover is finance. So I'm here to ask you to please do your part. We are looking for nominations for senior female executives in the New York area right now and in the San Francisco area. Our cohort for black executives of all gender identities is also open in the United States. We're going to be launching this in London and in Zurich in May, and then go around to about 5 more cities later this year. There's a lot more information on the New Voices program in the front where the magazine stand is, if you want to get more information on that. And all the applications are at bloomberg.com/New Voices. And I want to leave you with this. If you care about representation in your own firm, you need to care about how your firm is represented in the media. It is important for our coverage, and I would argue it's also important for your business. Thanks so much.
Digital currencies are reshaping the investment landscape, and so are we. As the world's first and largest digital currency asset manager, Grayscale is the investment partner of choice for individuals and institutions. Go digital. Go Grayscale.
Please welcome to the stage Principal of CIM and President of CCO Capital, Emily Van Kroll, Crow Holdings CEO Michael Levy, and Cadre founder and CEO Ryan Williams with Bloomberg's Natalie Wong.
Hello, thank you for joining us today on our panel on the future of real estate. We've got a great panel of guests in a short amount of time to cover a lot of ground, so I'll just kick in with the first question. You know, there's been such an incredible accumulation of wealth, and we've seen more and more of that increasingly being directed towards real estate. So Emily, I'll turn over the first question to you. How has this wealth boom impacted the world of real estate and real estate investing?
Thanks, Natalie. I'm actually excited to answer that question, mostly because for CIM, we've experienced it as it's really shifted from the defined benefit plans and moving into the hands of individual investors. Luckily, we have built from the beginning something that is our community-based approach, where we're able to offer a really wide range of assets and asset classes to the individual investors, but we're really seeing that they want to take control, they want to understand, and they know that real estate is a very important piece of their portfolio. We now just have to find the ways to actually deliver that to them in a way that they can invest individually.
Ryan, what have you seen on your end in terms of this demand from individual investors for real estate, and what opportunities does this provide for firms like yours?
Yeah, so we're pretty well aware that real estate is one of, if not the most important asset class to own to build long-term wealth. We're also aware, and I'm personally aware, which is why I founded the business, of how inaccessible it is for the vast majority of people. And so Cadre's mission is ultimately about democratizing access to real estate. It's leveling the playing field between institutions and individuals. And we don't want a repeat of what we saw happen after 08-09. When there was a huge influx of wealth created, but for a relatively small part of our global economy. for the largest institutions. And so what we're doing is making real estate more accessible through technology. We're letting people invest in high-quality institutional-grade real estate at lower minimums with greater transparency so they can see what they own, and with liquidity. We built the industry's first secondary market to give them financial flexibility. And we actually launched a product, the Cadre Direct Access Fund, that was focused on asset classes and sectors we thought would be especially resilient coming out of the pandemic. We're proud that we've enabled thousands of individuals to be able to actually invest in those same asset classes and hopefully benefit from the recovery in a way they weren't able to in 08 and 09.
Perfect. Michael, we spoke on the phone last week, and you mentioned that individual investors are increasingly looking for more illiquid opportunities in the market. Why is that?
Well, I think intermediaries, whether they're broker-dealers or RIAs or investment managers providing advice from sound portfolio management theory, seeing the information and relationship advantages of illiquid assets, to the extent that you can withstand the illiquidity, they're increasing the overall exposure in their portfolios beyond public securities. And so the advice they're receiving from their financial advisors is to increase their exposure to illiquid alternatives. That just trails institutional investors that have been pursuing this for a number of years. It also gives these same firms an ability to differentiate themselves versus the products being sold in the public securities markets. And ultimately, the economics of these illiquid alternatives offerings are more advantageous for most of those intermediaries. I think all those forces are at work driving the growth of this sector.
We've seen incredible competition and capital building up on the sidelines, whether it's from private equity firms, debt funds, or individual high net worth investors over the past 2 years looking for real estate investment opportunities. You know, what types of assets are individual high net worth investors looking at that's more attractive compared to institutional investors?
Yeah, well, I can talk about from what we've seen at Cadre. And what I would say is that the number one focus, a lot of the individual investors, and we've got nearly 40,000 individual investors on our platform, is yield. Now, yield's really challenging to find today. And so what we like to do is help individual investors understand why it's important to also have a balance of growth and value alongside that yield. That's why we launched a portfolio offering as the first offering that would be more widely accessible for individuals to invest a few $1,000s per property at the end of the day. And so what we've focused on is diversification because in a world where you don't give that kind of insight, people tend to look at the biggest number, the greatest headline IRR or yield threshold without properly assessing the risk. And over time, what we've been able to do is help people understand that there is a place for risk, there's a place for yield, and have a true institutional type portfolio. So yield is what everyone's looking for. That's not what the market's necessarily delivering today. And instead, we've shown folks that real estate on a diversified portfolio basis can be a great hedge against inflation, and tried to focus investors, individuals, in that theme versus trying to promise them the world.
Are there specific assets or geographies where investors are more drawn towards these days?
Well, I was actually going to add real quick, if you don't mind. I don't think there's a difference in what our high net worth individuals are looking for in terms of a stable real estate investment from what we're providing to the institutions. And at CIM, what's really important to us, the platform that we built based on a community-focused type investing, and then our vertical integration, has allowed us, and other managers have similar advantages, but really allowed us to go across the risk-return spectrum. Individual investors coming in want to have the same opportunities. They don't want to be secondary to the institutions. And now what we're looking to do is build the vehicles for them to be able to come in right alongside. And it's a very natural transition from our business, something that we've been doing the whole time, and continuing with that vertical integration to have a great view from basically birth to disposition of an asset to be able to offer it all. And I think it's important that the individual investor feels that same ability to access it as the institutions.
My add, and I'll go on sectors. I do think there's been an explosion of demand for both yield and liquidity if you look at the non-traded REIT market and how it's exploded in the past couple of years. So I do think there's demand, and that would be distinguished from some of the institutionals. In terms of asset classes or sectors, I've never seen the boat so tilted in my career. You know, the market is industrial, multifamily, and some of the specialty sectors, and that's where the fund flows are. That's true institutional, and that's true individual. Now, that doesn't mean there isn't a bid for or interest in other asset classes such as office or retail, but if you really look at the fund flows data, that's where the fund flows are because that's where growth is. And investors are pursuing growth, and the secular fundamentals underneath industrial and multifamily are compelling.
Well, let's dive into that a little bit because everyone's going towards apartment, rental buildings, and industrial with the growth of e-commerce. So where do you find the most attractive opportunities out there to compete against, the likes of Blackstone, Prologis, the big institutional investors that are all scooping up these types of assets as well?
Yeah, I'm happy to jump in.
Yeah.
Look, I think real estate's a massive industry. It's not necessarily a winner-take-all industry. And just like, in the stock market and the equities, I think the beauty of it being such a big industry is there's always micro opportunities within that macro environment. If you find the right management team, you find the right operating partner, you can outperform the market. I look at what Michael and Crow have done in industrial, and they're an incredible example of amazing management that's been able to differentiate themselves and the exact types of partners that we get excited about offering up to individual investors. And so we focused, as Michael mentioned, on multi-industrial, life sciences, but we're overlaying that with geography as well. One of the novel things that we've been able to do at Cadre is develop a data science-driven model for market selection. Now, I'm not saying that robots are picking which markets we're investing in, because that's where I think people get carried away. I am saying that we've built a model, including the Cadre Property Price Index over the last 7 years, that's helped guide our investments team as to where there's growth, where there's appreciation, where there's affordability. And so when you overlay the asset class with some of these markets, then I think you can find real unique value and opportunity. And they might be markets that are less liquid. We recently looked at a deal in a big college town in Michigan that otherwise we wouldn't have looked at if we hadn't recognized there was unique affordability and unique growth in that market and that sector. And we like to, again, overlay those two dynamics to find opportunity when things are hyper-competitive and where there is a lot of capital on the sidelines. I think that's the winning formula that we've been able to employ so far.
Got it.
When you have that competition as well, I think it requires a piece of creativity in the other asset classes. And so in our approach and in being boots on the ground in every single community where we're investing, you can look at something like retail, which most everybody at this point would, you're like, oh, I'm going to stay away from that. But how can we take a creative look at it, and based on the community where we're at, maybe they're in need of some creative office. Maybe they're in need of a multifunctional type of space where we can bring down some of the retail exposure and convert to something like multifamily. There's opportunities, but a lot of it is really understanding the communities that you're in and having the ability to, it's not just the third-party data, it's your boots on the ground data that's really going to allow you to make some smart purchases and opportunities, regardless if one sector is hot or the other. You can still really balance it out.
The business remains, notwithstanding the data scientists, it's a relationship business. Getting the benefit of the doubt, getting the first call, getting the last look. The business is intermediated by people. And doing what you said you're going to do and having boots on the ground and relationships built over time, that's the edge. There's no secret sauce in the business. That's the edge. And you earn that by doing what you're going to say over time. And the largest asset managers are terrific, but they're going to chase multi-billion-dollar portfolios. It's a massive asset class. It is highly fragmented. It is highly local. There's opportunity for small mom and pops, and there's opportunity for trillion-dollar asset managers.
That's the conversation Michael and I were just having before we came out here. It's about building the relationship, especially as you move into the high net worth space.
Right. Well, we talked about what assets people are attracted to, apartments, industrial. What are some contrarian bets that these individual investors are looking at and that you guys are looking at as well? Emily, do you want to start?
Yeah, sure. We're big on debt right now. So we've seen, again, through having the relationships, and experiencing real estate through acquisition, our own underwriting, we are very comfortable taking on the construction debt space. Banks tend to shy away from it. It's a complicated underwriting. You have to know what you're doing. You have to know the value of the end property. And most importantly, you have to be able to understand the pitfalls that you can fall into along the way. Falling short on timeline, over budget, all of those things that have caused an increase in the rates, which means we can get some great returns on it. But it's actually a very good, stable investment. Something that's difficult or more difficult for an individual investor to come into on their own, but through an asset manager that can do it well, it's been a fantastic conversation point for us, and we've shown great returns and work through that over the years.
Michael, Ryan?
Most of what we're pursuing is growth. There is one area, and you mentioned earlier, retail is in the midst of major change and disruption due to e-commerce and other forces, and fund flows to retail is pretty poor. But to your point earlier, not all retail is the same. And so in the communities you live in, I guarantee you there are these boxes. They have 6 tenants, they're 20 feet wide, maybe 60 feet deep, and they're all food and service. They're your Starbucks on one end, and your Jersey Mike's on the other, your cupcake store, and your dry cleaner, and there are tens of thousands of them in the United States. And there's very limited fund flows to retail real estate today. And those boxes are not getting disrupted by the internet. And in fact, during COVID, those boxes did particularly well. Where did you buy all your food from on those apps? And so we're trying to swim where the capital markets may not be swimming, and that is the one area that we've identified and been executing on. And I still think it's a great opportunity and will be for some time, because you keep reading about the negative news about retail, and that helps. So.
Creative office as well. It's another one that lands in there. We may be moving out of the high-rise office space we're all experiencing in New York. But creative office, if you're talking about studio space, podcasts, which we're all used to and doing now, needs space. And so again, if you can get creative with it, there's some real opportunity there.
Well, we talked about the importance of geographic locations and certain investments. Prior to the pandemic, everyone was looking at major metropolitan cities, New York, San Francisco, LA, and we've seen an increasing move towards more secondary markets. Ryan, I'd love to hear your thoughts on this. You're a New Yorker. What are your thoughts on investing in New York City? Are there any other markets that you guys are more bullish on?
Yeah, so I would actually say we pre-pandemic, we're not investing in the big cities, the big markets, largely because we couldn't really justify a lot of the valuations or cap rates. We like to think that we were focusing on some of the quote-unquote secondary cities that have now been primary before they were hot. So markets like Phoenix and Nashville and Savannah and Atlanta and Dallas and Tampa, that, if you looked at our portfolio pre-pandemic, was the vast majority of what we owned. And then in terms of asset classes, we didn't really own anything in CBD, big office at all. And so we actually indexed more to suburban office. We thought there was a unique opportunity in terms of just the cap rate spread and buying something in Greenwich, Connecticut versus in downtown New York. And we've actually seen those suburban office assets perform incredibly well. So now the question is, okay, well, what are the next, kind of cadre 15? What are the next markets that we think are currently being considered secondary? To your point, some of the previous primary markets actually are starting to fall in that box because of affordability. So New York actually is one of the markets that we have been increasingly looking at from an investing perspective, largely because the affordability in many pockets of New York has actually increased, given you've had a lot of people move out to the suburbs and stay put. And so we're bullish on New York. I'd never bet against New York. I think though there is an element of asset class selection that has to be right on top of the money in order to really excel, because it is a hyper-competitive market. I think there's a lot of unique cultural dynamics associated with New York. And I think there are a lot of other cities that will rebound, will take some time, and where there could be opportunities, again, on a micro level, to snatch up investments. But we spend the majority of our time actually focused on markets that a lot of people are not talking about, that we think will be that next, cadre 15, where there will be liquidity flowing in, 3 to 5 years from now, where there's, millennial inflow coming out of the pandemic, where there's proximity to academic institutions, where there's geospatial and mobility data that gives our team conviction that this will be an area that will continue to see population density, and where there's relative affordability and city governments that are business friendly as well. So that's kind of the strategy for us, is not big cities, but that next cadre 15 that hopefully a few years from now people will say is now a primary market as well.
I think there's a macro view and a micro view. The macro view is one simple rule to invest in real estate is invest in real estate where people are moving to. And so people are moving to the Southeast and the Southwest from the Northeast and Midwest, and those trends are clear and have been clear for years, and that secular trend is not slowing down. That secular trend is increasing. But within that, some examples, there are other places in the country where you don't have that growth, such as the Chicago area, where the distribution infrastructure is so unique that industrial in Chicago is a massive market, and there are opportunities in that. But as a general rule, we are investing in those markets where people are moving to. Now, our company is headquartered in Dallas, Texas. We do have offices, 20 offices across the country. So the places where people are moving to the country is our neighborhood, and those are the markets that we're largely investing in.
So in this environment of market volatility, lots of things happening in the macro environment, what are the biggest risks that you see nowadays for investors? Emily?
I'm going to go back to the debt side of it, actually. We haven't seen a lot of the distress in the way that we thought we were going to. I think when COVID hit, at CIM, like many managers, there was a sense of, okay, where are we going to have to try to pick up some different pieces? And we really didn't. There was a blip, but we didn't experience it, I don't think, to the level that most of us expected. Where we're anticipating now, and as we're connecting with our communities, is really on some of the different, particularly the retail, office, and some hotels, of they got some relief on their lending going when COVID first happened, and now that's starting to wear off, and we're in an inflationary period. We're also at a point where they haven't been able to get occupancies back up, and it's in a lot of the city centers or the industries that we mentioned, where they're really going to just struggle, and now they have to refinance, and I think we're going to see some distress in those areas. The thing is that retail not too long ago was actually a go-to as a consistent income flow on long-term leases, and that's going to start to see a little bit of a challenge as well. So adapting to it, listening to what we see potentially coming down the road, and then making it an available investment as well.
Michael?
Myriad of risks, but the reality of what's occurring right now is we've got inflation, rising interest rates, and you're starting to see real time the impact on the cost of credit and the availability of credit, particularly as it relates to the office sector. It's happening real time, and so it's math. And particularly if you have sectors that aren't benefiting from inflation. So if you have an apartment building, you're rolling the leases over every month, you're picking up the benefits of rental growth, you're able to absorb these rising credit costs. But if you have buildings that have long-term leases in them, or you're concerned about the ability to release it, that cost of credit is not being absorbed in your rental income. And so those assets and those sectors that cannot absorb it are going to hurt. And right now, as we speak, the office sector is getting impacted. And the reality is you're seeing 10 to 20% deltas in pricing in the past few months. You're seeing deals being pulled. And even in sectors that have growth, like the multifamily sector, pricing is at the margin. People didn't expect this new cost of credit, and you're actually seeing some small retrades. Now, that's not going to turn into distress, but nonetheless, it's this inflation and cost of credit. We run a levered industry, basically, and so the availability and cost of credit, and it's happening real time. And I don't know what the future will hold, because none of us do.
Given all this risk, what assets or investments are best protected against this inflationary background?
Well, I mean, talk about what we focus on, multifamily. People are always going to need somewhere to live. And, the reality is there's some other macro trends as well that exist that have made multifamily and industrial especially attractive as an interesting hedge. You think about supply chain issues we have, and there's a lot of concern about supply chain and building and development. It's actually acted in a pretty interesting way. It's muted a lot of new supply in some of the markets on the multifamily side that we invest in. And so as a result, we've seen renewals at our multifamily properties stay all-time highs in terms of people signing up new leases. That also is amplified by the fact that it's hard to buy new homes, and the pricing of homes is frankly astronomical and almost antithetical to the American dream. And so we like multifamily, of course, because of the fact that it provides a pretty consistent cash flow yield profile for our investors. I think it's relatively counter-cyclical. And I think on the debt side, financing you can get in some cases actually becomes the asset itself, given where rates are in that space. So that's where we've spent the bulk of our time to date. I think there's a lot of macro trends that will sustain that as well.
Perfect. We spoke a lot about how real estate is a lot about interpersonal relationships. When you think real estate, you think physical buildings, physical assets. I'd love to talk a little bit more about the impact of technology on real estate and real estate investing. I mean, traditionally, real estate has been a bit slower to invest in prop tech and pick up technology. Emily, how are you guys looking at the use of technology in real estate investing?
Yeah. I'll be the first to say I'm not the expert on prop tech. So, but where I think it's important as it pertains to the high net worth industry and moving into that investing space, what we've seen is a high demand of making sure that you are providing accurate, obviously, and timely information on what they are invested in, why they're in it, when there's news that there's responses. So I think you'll see a lot of managers from just a technology standpoint on media and information flow increasing, and then making it easy for them to be able to come into your funds. I think Ryan's gonna, has quite the network built there, being able to come in and subscribe. But we're going to have to constantly be keeping up with what our investors are looking for.
Technology's been impacting real estate my whole career. I mean, first of all, it's created sectors that didn't exist. Data centers, biotech creating life sciences, towers due to cell phones. And so you've had the creation of real estate asset classes. You've seen information management, the ability to get information on fundamental supply and demand dynamics in a given market through a multitude of forces. Your HVAC and energy systems that now you can control, building materials that have improved, capital markets tools that allow various market participants, auctions. And so this is a mosaic. There's been a ton of money that's fled out of the VC world in the past 5 years as the last vertical. I think it's great because we all benefit from all that capital. But there are areas that fundamentally the technology industry has overstated its ability to impact. And two of them are very obvious. It was in the 1990s that we were going to disrupt the residential real estate brokerage industry, right? Everybody was going to do that. Everybody in this room, when they sell a house, probably hires a broker and pays 5.5 points. What we did was give the residential real estate brokerage industry better tools. There are numerous examples of construction technology failures that have gone on. One of the businesses we run is a large construction development business. I assure you, it takes human beings to build buildings, and there are people working on robots building buildings. So I think that there are things that have been successful and really impactful and changed the course of events. I think things have been, there's been hyperbole around other things, but I think it's wonderful, and I love to see this capital come to the business because it just makes the real estate business better for all of us.
Yeah, well, clearly I started Cadre now almost 8 years ago, when the prop tech terminology was laughed at, and when the idea that technology could have any impact on how the real estate investment world operated was laughed at by a lot of big institutions, now many of whom are espousing technology and talking about their prop tech business arms. So that's exciting for me to see everything come full circle like that. In terms of technology, though, look, technology can really do two things. It can create destruction, or it can create creation, can rebuild and reassemble. And I think what it's doing in real estate is the latter. I think we're seeing right before our eyes the fundamental change of who can access what has been a closed network for so long as a result of technology. It's recreating how investors are able to participate in the asset class. And again, we're proud that we're a small part of the democratization and the opening up of the asset class. There's many others as well. It's changing how operators and developers raise capital for projects. We'd like to think that what we've been able to do is provide a more flexible capital source. It's changing how people who actually own real estate function and operate in the interim by giving liquidity, which is something that hasn't existed for individuals. So I'm incredibly excited about how technology will transform real estate for the better by leveling the playing field for all market participants. At the same time, there has to be an acknowledgement that relationships are critical in the space. And that's what we've tried to do at Cadre, is bring folks like Mike Fascitelli, who chairs our IC, alongside engineers from Google and Facebook under one umbrella, because there has to be parity. And that's where I think people have got things wrong, is when they index too much towards the real estate or the technology to try to build something that's novel and innovative. And it's together that we see the kind of magic that platforms like ours are looking to create.
We've only got about a minute left, and I'd love to end this panel with a question about the metaverse. We've obviously seen so many banks get into this. JP Morgan called it $1 trillion market opportunity. Real estate seems like it would have a natural place in this virtual world. So I'd love to hear what your thoughts are on the metaverse, what the opportunities are. Ryan, go for it.
Yeah, I think similar to frankly just crypto, there's a lot of terminology that gets thrown around, and there's not a lot of fundamental understanding. I think we all can agree that there is way more virtual engagement, just generally, right, in terms of how people are interacting with each other, how they're engaging, even in the transaction world as well. I still think that there's not enough guardrails around things like the metaverse and Web3 and the like for it to be something that is really going to change and move the needle, like, from an investor's perspective as to whether or not they should be jumping into this space. But I believe in decentralization. I believe in opening and democratization of access. And I think it is a matter of time before the metaverse does become something that is more practical, tangible, and value add. But we're still ways off, just like I think we're ways off from blockchain reinventing who can invest in real estate and who can't.
Okay, perfect. Well, I want to thank our panelists for joining us here today. Thank you so much, and thank you for listening to our panel.
Good, thank you.
Thank you.
Only 45% of investors say they have an estate plan. Do you? Only 47% of investors say they have a strategy for passing on their assets after death. What's yours? Try our Active Wealth Accelerator to learn how to be proactive about estate planning.
Please welcome to the stage art advisor at Schwartzman and Art Advisory, Alan Schwartzman, with Bloomberg's Mark Miller.
Good afternoon, everyone. We are heading toward the close of the Bloomberg Wealth Summit, and for a bit of something slightly different, although it's been touched on a couple times today, we wanted to talk about the fine art market. Modern and contemporary old masters, of course, included, although at this moment the hottest part of the market is around modern and contemporary. And there is no one better to talk about the art market with than Alan Schwartzman, who's been a curator, a museum curator, was the chairman and co-leader of the fine art division of Sotheby's, and now is running his own consultancy, which is Schwartzman & which provides a range of consultancy services to collectors, museums, and artists, for that matter, and who has actually just concluded his own two-day event. So he's been talking a lot about the art market recently. So welcome, and thank you very much, Alan. So as we know, the stock market and other aspects of the global economy are, shall we say, unpredictable at the moment and roiled in many ways. We could get even deeper into how the post-World War II structure of of the world is being shifted even as we speak. But at this moment in time, then, what does that mean for the global art market? And I think, as in so many ways, Andy Warhol can speak to this moment.
Absolutely.
There is, I think, you wanted to start, I believe, with Orange, Maryland, which is Andy Warhol's piece from a series in 1964,
Yes.
I believe, right? So if we could show Orange, Maryland. And then, Alan, why is Marilyn Monroe and Andy Warhol relevant to this moment?
Okay, so first I would say that in recent decades, when the stock market goes down, the art market goes up. It runs counter to what people would assume, but that's quite consistent. The only time there was a slight variance from that was in 2008 to 2009, which wasn't really about markets, it was about people's comfort with how long they needed to keep their cash around for. But even so, the art market was quite active, just more privately than publicly at the time. And contrary to what many people had said and expected, there really weren't great bargains then. It was more bargains of opportunity than of price. So I want to talk about the Orange, Maryland for a moment, because historically, over the last 4 or so decades, the living artist who had always commanded the highest prices was Jasper Johns. Jasper Johns, for those of you who know the work, is a master of technique and a mystery maker of image. And because of that technique, I believe, he was most coveted by the market consistently for decades. And if you look at Andy Warhol, these are two artists at different ends of the spectrum of what was called pop art. We could argue whether or not Jasper was really a pop artist, but let's not get into that. And while Andy Warhol was by far the most famous artist of his time, because he really focused on fame, and despite the fact that he was understood to be functioning within a marketplace as a commodity himself, his prices in general were 1/10 that of what Jasper Johns were. A record price was set for Jasper Johns in, I believe, 1989, which stood as the record for the work of a living artist for many years. It was for a painting called False Start from the 1950s, and it sold for about $17 million. At that time, you could have bought a best Warhol for $1.5 million. In 1988, which was, I should say, there was Black Monday took place in October, I believe, of 1987. And in May of 1988, this Warhol painting sold for $17 million. So there became an equivalence in value in the eyes of the market for which there had not been a precedent. The way I look at it is Johns, and most of this market has been set by American collectors, but the way I look at it, Johns was an American collector's fantasy of what a great painter was, and Warhol was the reality. There was generally this perception that because it was rooted in photography, because he did multiple versions of the same image, that somehow there wasn't connoisseurship in the work, or that the work could have been perceived of as superficial as he tried to make it look. But in fact, there was much greater depth to that work, and sometimes it takes a few decades for an artist's significance to sink in, and that's.
And the estimate for the pre-sale estimate was something around $4 to $6 million, not the 17 that I went to. Ultimately. Okay, so cut to today, there are important auctions happening in May here in New York. And from this same series, there are 5, I believe, in this series. There is Sage Blue Maryland, which is going on the block with an estimate. Can we show, this is Sage Blue, it'll be at Christie's, with an estimate of $200 million, which would be...
Same dimension.
Same dimensions, exactly. Which would be, if achieved, and you said these things generally happen the way they are meant to happen. You know the auction world well. this would be the most expensive painting from the 20th century sold at auction.
Interesting. So there was a third Marilyn from the series. I think it was the Red Shot Marilyn, which sold privately just a few years ago from the collection of Cy Newhouse for what was reputed to be, by some people, $200 million, by others, $250 million. So that was oftentimes private sales at those levels disappear without one hearing about them or without one having clarity on pricing. But there was a little bit of a chatter about that one in particular. Usually the way auctions go at this price level, and by the way, I'm giving you a general view because I haven't checked to see if this is a painting that has a guarantee on it. I assume it has a guarantee. But the way sometimes very expensive works tend to sell near the low end of what their estimate is. And the natural interpretation on the part of the art press is that they were really pushing the estimate and the market was sluggish. In reality, what happens with these top-level prices is that what's already taken place is a private auction, in a sense, between Christie's and Sotheby's and sometimes Phillips. And they keep beating each other up in the guarantee game based upon best-case scenarios that they envision for themselves. And so it's as if the work has already gone through, you know, the 4 or 5 most likely candidates. So I don't think that that perception is actually accurate to the reality.
So the fine art market is doing well, shall we say?
Super well.
Right. There's an influential market report done by UBS and Art Basel that showed that in 2021, between dealers and auctions, sales reached about $65 billion, which was pre-pandemic levels. And we expect, I would imagine, that to go up even more this year, despite or maybe because of
Well, what happened
the
during
market?
the pandemic is that initially dealers were just very cautious to reach out to collectors. They did not want to appear inappropriate in their behavior or desperate. And in reality,
Were
there
they
was
desperate?
You'll never know. Actually, they weren't. The market was far more successful and at different price levels, not just at the top at that time. But galleries did a great business up to certain price levels. Certainly for the work in the primary market, which is where new work by living artists gets exhibited for the first time. And in the secondary market, meaning when it's resold, whether through auction, and the auctions remained active online, which has now, in a sense, permanently shifted that culture, up to a few $1 million. And then it slowed down insofar as oftentimes to get to $50 or $150 million or more requires a certain amount of theater of presentation of a large auction, even if none of the actual bidders are in the room. And oftentimes the person who can spend that amount of money, their appetite benefits from the feeding of a notion of potential competition, but also the hunger for something really gets fueled by the object itself. And there's just so far you can go in being convinced of the significance and desirability and singular greatness of a work of art when it's at these kinds of price levels and when you don't have to buy it.
Right, right.
So that part of the market will be coming back at this point in a more visible way. Not that it wasn't there whenever the last major sales were in November.
You said something in our conversation that we had before we came on stage about how the art buyer has changed over the years that you've been observing this. And the focus has moved from, how did you put it? It's moved from the artist to the artwork itself. What do you mean by that?
Okay, so this art market, and by this I mean this market for post-war and contemporary art, began its momentum around 1980. And from 1980 onward, there was an increase in the number of collectors interested in contemporary art. By and large, these were collectors who were new to collecting And historically, particularly in the United States, but most everywhere in the world, a new collector would collect the art that was new from the moment that they entered the market. And as an artist matured, they would either stay with the artist or they would keep moving on to the next younger generation and the next younger generation. And the idea of being connected to art at the beginning of his exhibition was part of both the ethos and the social aura around collecting contemporary art. About maybe, I'm going to be off with my numbers because I think everything was 5 years ago, but probably about it was after the last big crash, which was the 2000s. When the art market, what happened at that point was that there were there were new people who'd entered the market in the previous decade. Many of those were speculators who had not been in the art market before. Prices started to go up at a much higher trajectory than before, and you had a number of contemporary collectors who overextended themselves because they didn't want to miss out on a success that was in part rooted in their activity. And so you had some people who were financially extended. When the market geared up again in, I guess, around 2005 or so, there entered into the market a number of very different collectors. They tended to be much richer than the rich people who were collecting contemporary art before. They were much more international. They were people who had very little time to focus on the art, whereas the collectors before them would spend every Saturday going to galleries downtown or in whatever city they were in. And they were people who entered with a certain amount of, usually the contemporary collector kind of learns by making mistakes. These were people who entered with a list of 12 artists they knew to be significant and worthy of collecting. And so therein you had a wider range in age of the artist and a search for particular works, more often than not acquired through auction rather than through galleries.
So there are just a lot more people in the art market now than there used to be, right?
Correct. And in the last, let's say, 5 years, even the last 3 years, there's been a great uptick in the number of people collecting, certainly at the highest ends of the market, and who are prepared to pay extraordinary prices, for whom maybe the difference between $50 and $150 million doesn't really sound like that much to them.
Okay, so let's put that group of people aside. But for other collectors who really see this as this market as a way to, again, to speculate in the way that they did in the past, because the numbers are so gigantic now. Do those people who don't really know the artist but know that this is someone they should be buying or think they should be buying, is that a smart investing strategy?
One can do extremely well investing in art, not that I like to use to combine those two words, because I do think you should first and foremost love what you buy.
Right.
Be prepared to live with it if it never goes up in value. The collectors who, you can make big mistakes in the art market. If you put like 2 Robert Ryman paintings from 1967, which is a great year for Ryman, that look like pure white paintings, 6 foot square, seemingly equal to one another, there are usually big differences, and that takes connoisseurship and eye and knowledge of condition and so on. So if you're buying just by name, you could make huge mistakes very quickly. It just so happens that as the art market got smarter, richer, and more select over the last 20 years, and particularly in more recent years, what you find is more and more that a collector is willing to pay, a top collector is willing to pay so many times above what the value is for an extraordinary work by a widely recognized significant artist than for an average work. And so within the markets for many artists across the board, you see the middle of the market having literally fallen apart. It's a Donald Judd, a major stack could be $16 million. A lesser stack, same dimensions, same materials, maybe slightly different palette, might have difficulty selling it at $3.5 million.
Wow. Okay, so we don't have a lot of time left, but there are a couple things I want to get to that I think also speak to this moment. NFTs, it's come up a couple times today in our conversation. I confess I don't really understand fully the market for NFTs. Is an NFT art or a collectible? Is it what is it?
It can be either.
Right.
There is a tremendous amount of interest and speculation and curiosity about NFTs amongst traditional art collectors. There are a good number who are actively seeking to collect or learn more. But at least how I see this, which is limited in my knowledge, but when I've expressed these opinions by people who really know the market, they say, oh yeah, that's right. You basically have a market that's been created by the people who created the cryptocurrency. And so what objects or things NFTs have been connected to that have brought extraordinary prices are more often than not what the art world would consider art. Artists who are not known particularly well in the art world, if at all. Artists who, or creators who even in the digital world would be considered insignificant or superficial. And so there's a gap between demand and the quality of supply. When that happens in the art market, you eventually, sooner or later, see a market collapse. You can't artificially create and sustain a market at high levels for an artist who is who is substantially lesser than his prices would suggest. The NFT market is a different buyer. So right now, you've got these extremes. What remains to be seen is, or where that market can start to make sense and be lasting in relation to art, is when compelling artists make compelling work in the medium. There are challenges to it, some of them having to do with storage space and so on. There are some significant artists working in NFTs who are working in digital space to begin with, most of whom have not been able to sell their NFTs for any more than they could sell their art.
Right.
So there's a lot of hype surrounding it at this point. And there is a new market for, let's say, cultural artifacts that you could not value in the past, such as the first tweet. That, in a way, becomes far more interesting to me.
Right. That makes sense to me as something of value. Right. One of the good things I think in the kind of burst though of interest in contemporary art and the expansion and buying of emerging artists is that there is much greater interest now in work of artists of color, for example, than we previously had. Right. Which to me is one of the upsides of what we're seeing here. We're actually looking at a painting from a British painter, Lynette, I'm going to unfortunately butcher her name, Lynette Yadam-Boeki, I believe, who has been working for 20 years or so, but is having an important moment, had a big show at Tate. This is sort of not the best quality to see this image, but really remarkable art. What's your view on what we're seeing?
Okay. So first of all, in full disclosure, this is a painting I own. And, and it was like, how do you choose an image and how do you get a high quality, a well-resolved image quickly? I happen to love this painting. It's quite characteristic of the artist. This is more of a medium-sized painting. It is a frontal portrait of somebody whose personality and psychology seem to have been extremely well captured. In reality, her paintings are never of real people. These are people she imagines and envisions, which is interesting to know. Second, the way she uses color in her paintings, I think, says everything. Meaning the dark green against the black. It's a kind of palette you would see in American Ashcan school painting from 1908 more commonly than contemporary art. And where she chooses to leave the canvas raw or just primed and reveal white, such as the edge of the cuff or the whites of the eyes, I think is where the humanism in the work comes out. And so she's kind of reversing the politics of color in her work and dealing with white kind of as the blankness that one might have historically referred to black with. But more significantly, there's just been a lot of artists. There's been an increased interest in art coming from other cultures since the early 1990s. We've had many different phases of globalization within the art world and the art market, but we've reached a critical mass now of a great number of artists of color in the United States who have become of increasing interest to museums and private collectors, in part because there's a lot more compelling work, in part because there are many artists working in related ways that creates a kind of spirit of a certain art of our time, and in part because of a great increase in the expression of social inequity and demands for change within the larger society that have been especially present over the same time that COVID's been present. I mean, this market got started way before then, but and what happens is it kind of I mean, every period when there's a lot of people collecting contemporary art, there are a lot of artists who attract attention who are not great and others that are great. And usually, you know, you have the ones who are not great working in ways that are derivative of the ways that artists who are working are great. It just so happens the numbers are greater nowadays. But am I going too far?
Well, no. But something you said to me in another conversation was that this moment also causes a reevaluation of art of the past.
Yes.
And for example, important artists of color, African-American artists, whose markets were neglected or not recognized, are now having their own moment.
So there are artists such as Romare Bearden, who was extremely prominent in all different kinds of collecting and museum communities, 1950s, 60s, and 70s. Faith Ringgold, starting in the 1960s, whose work was marginalized until her feminist work of later time. And in general, the way the art market tended to view such work was as a kind of stylistically overexplored figuration. It was seen as a more traditional kind of figuration. It wasn't the pure abstraction of abex or minimalism. It wasn't the mediated imagery of pop art as seen through the lens of the media. It was more like traditional painting. And so it didn't fit into, quote, avant-garde views of art. Today, when you have a much wider frame of reference of so many artists of color and of many different colors, and some of, you know, all different kinds of artists working in a realm of figuration, psychological figuration, representing local culture. And as that reaches a critical mass, then you can start to see things decades before for which there's a precedent that made this work possible that didn't have something to anchor it in what we understood to be great art of the time.
We could go on, but thank you. We have to leave. He did have a great story of a Basquiat sale that he engineered when he was at Sotheby's. So if you see him out there, ask him for it. Please remember, we have one more panel, and then we will have our cocktail hour. And thank you very much, Alan.
Thank you. Thank you.
Please welcome to the stage Redbird Capital Partners founder, managing partner, and chief investment officer, Jerry Cardinale, with Bloomberg's Jason Kelly.
Put their glasses. All right. So from art to sports, we're going to wrap it up. I'm so excited to be talking to you because we live figuratively in the same neighborhood, which is this intersection of sports, business, technology, media, culture. And it feels like we are in a really fascinating, lucrative, important moment. Do you agree?
Yeah, it's all converging.
Yeah.
You know, and it's been a 30-year transom. When I was at Goldman Sachs, and we were working with Paul Allen to roll up cable companies. Everybody thought that Paul wanted to go into the distribution business. The reality was Paul wanted to be in the content business, and he had a saying back then. He said, content is king. And he was just ahead of his time.
Yeah.
I would say today, content is king. And by virtue of technology disintermediation and an increasing premium on the live event and interactivity that those two things generate, which means that the fan is going to be much more active, not passive.
Right.
You're seeing an unbelievable convergence here.
Right.
When we invested in the Spring Hill company with LeBron James and Maverick Carter, they taught me something. I thought it was a media company, and they disabused me of that notion. They said, actually, it's a culture company.
Right.
And that was the first time I had heard that. And that culture company concept is the coming together of all those streams you talked about.
And when you have those sorts of collisions and intersections, money is sure to follow. You are unique but not alone in terms of seeing this economic opportunity. Mm-hmm. On the economics front, I'm going to go to the very crass level and just talk about valuations that are out there. I mean, people in this room, if you're reading the Bloomberg, which I'm sure you are, or almost any other major publication, you're seeing the headlines around the Broncos, Chelsea, other assets that are going to come up. What do you make of those valuations when you see 3, 4, maybe getting close to $5 billion for a single sports franchise?
Look, the valuation discussion is complicated.
Yeah.
I always remark in sports that, this is a multi-billion-dollar industry, and there's no equity research for it.
Right.
The equity research is Forbes magazine, or it's things like this, right? And that's why, I try to be somewhat participative with the media to get out to everybody what I'm seeing, because it's a distributed equity research type of an approach. The valuations, there's not a lot of rigor to it, only because it's a little bit of LIFO. I mean, it's just you look at the last trade and you put a markup on it. Now, what's alluring there and deceptive is that everybody's been used to this everything always going up phenomenon in sports. That's anti-Darwinian. That's not possible, right? Now, the slope of that curve may change, but for the foreseeable future, and certainly in the past, everything keeps going up. What's going to change? Now, if you pay attention to the details and you look at some of the competitive auctions for sports team transfers over the last several years, I would argue in some of those that they were fails. They came in meaningfully below what the price talk was around it. Now, either the price talk was wrong or the competitive dynamic wasn't there, but something, for someone who participates in this very actively, I see somewhat of a divergence that we should be paying attention to.
Right.
But the valuations, at the end of the day, on the glass half full side of it, I would say the valuations signal the fact that there is something very premium here. There is scarcity value, and there's something very unique in everything that's going on in media that you talked about with the convergence of those streams, where this is some of the best content that you can access.
Right.
And you can't TiVo it, right, in the old saying, and that's why you're seeing these valuations continuing to escalate.
For the younger folks in the audience, TiVo was this, look at it, Google it. So you brought up something interesting that I want to build on, which is this notion of the content, the entertainment value, and all of that. You and I were talking backstage, and you made me think about something in a very different way. Talk to me about the XFL, because that to me is one of the most exciting things that you're working on. I think you would agree. You've got some big name partners involved with you. Talk about household names. Help us understand how that fits into the current mindset and also the current opportunity.
Look, the XFL, for me, the investing, I've been doing this for 30 years, and the XFL and the stuff I do today in sports and media is really a continuum of 30 years of investing, right? And I think it's just harder for anybody to show up today from a standing start and start investing in these sectors. The XFL is so unique. It's an opportunity to create a live event media company with the potential to be global, rooted in legitimate football. Most people look at the XFL and see, it's a spring football league. Dwayne Johnson looks at it very differently. Dwayne Johnson, the great thing about Dwayne is if you said to him, maybe he's the biggest celebrity in the world, phenomenal human being, if you said to him, what's your one regret? First of all, I would think Dwayne should have no regrets, right?
Right.
If you ask him what his one regret is not making the NFL. And he remembers back to when he didn't make the NFL and he went to the Canadian Football League, and then he basically went into wrestling because he didn't make it there. That is a passion for him that he wants to now revisit and make things available to fans and players particularly. So his whole ethos, what to me was, look, we should look at this a little differently. Obviously, we're not the NFL, but there's a need. We did the work, and there's absolutely a desire and a need for spring football, right? So there's no binary risk there. Then the question becomes, with a partnership with someone like Dwayne and Danny Garcia, can we create a new version of the way people think about leagues and sports, where it's rooted in true live event entertainment? You put a very credible and an NFL quality type product on the field, but you put the fan and you put the players at the center of all of that. And then you have an alliance, a partnership with the NFL like we've established, where there is actually a synergy, where some of the things that we're going to be doing experimentally can be things that the NFL adopts, and then it helps the whole ecosystem. So I'm fascinated by this. I think it is as far as I'm probably ever going to go to something like this.
Right.
But I'm very proud of the fact that with everything going on in the world, and you talk about the convergence of sports, media, and culture, this is the first league in history owned by a diverse woman and an African American. And we know in traditional professional sports, that's easier said than done.
Yeah.
And so that's also something right out of the gates that, in our own little way, we're kind of advancing the ball in so many important areas that reinforce that convergence.
So let's talk about that element and kind of stitch the two things we're talking about together, which is these valuations which are going to the moon, presumably, and also I think a broad social desire for diversity and inclusion. If you're asked to write a check for a top tier EPL, NFL, MLB, NBA franchise, you got to stroke probably $1 billion check in some ways. It's a pretty limited number of people who can do that. Structurally, what do you see happening, especially for folks who are in this room, some of whom may be billionaires and ready to write a check, others of whom may not be. People watching as well. How should they be thinking about investing in sports and in the broader ecosystem?
Well, look, investing in sports is, you got to ask yourself, well, what does that mean? And most people think investing in sports is buying teams. I've made a career out of investing in anything but the team. I've made a career out of partnering with the rights holders who own teams and leagues and creating terminal value, multi-billion-dollar businesses around those rights holdings. Over the last 5 years, where I've evolved in my investing career is I said that, maybe I'm ready now to become the rights holder myself, and let's vertically integrate that activity.
Yeah.
And that's some of the things that we've been doing. Sports team ownership is going to need to evolve if you want to see this continued escalation in these asset valuations. Ownership rules are going to have to change. The type of capital coming in will need to evolve, all of which is positives. And there's no negative the way it is now. It's just that, these all have become multi-billion-dollar mini Disneys. And, my career was, you've had this massive escalation in asset valuations, and really none of the people or the infrastructure has really kept pace.
Right.
And so what I've done is I go in with capital and a company building mentality, and I close that gap. And in the process of closing that gap, I create multi-billion-dollar businesses. So, the ownership rules will catch up to that, and that'll attract my kind of capital. My kind of capital right now sometimes can invest in teams, sometimes it can't. In Europe, it can. There's no restrictions.
Right.
In the NFL, it can't. And then some of the attributes around number of owners, there's limitations around that. The minimum ownership percentage that the control owner needs to have. All these factors, everybody's going to need to, in each of these leagues, is going to need to look at that and figure out what's best for the league and the teams to ensure that the right kind of support is coming in financially to continue this progression.
Right. So as I think about, myself and other folks in this room, we are, many of us, consumers as well as investors. And one of the places where that rubber meets the road, as it were, is in the media world. I am a cord cutter, probably later than others, maybe well ahead of others. But you know, I think about how I consume sports. I think about how much has changed in the rights landscape with Amazon getting Thursday Night Football, with all of that being realigned. How would you describe sort of the state of the media side of pro sports and how we should be thinking about it?
Well, look, I mean, you know, we created the Yes Network with the New York Yankees back in 2001. We sold it to Murdoch in 2013. We bought it back in 2019 with the New York Yankees and Amazon. Very different plays. When we started, it was a growth equity play. We sold it for $4 billion, bought it back for less than that. The EBITDA had doubled by that point from when we had sold it, and we bought it more as a different type of a growth play with the potential for a whole re-underwriting for version 2.0 based on direct-to-consumer and based on more interactivity with the fan, which we talked about. You know, the demise of the cable bundle has been greatly exaggerated. When you look at just ESPN, you know, ratings are up 30%. You know, viewership is up 40%. When you look at the Yes Network had 8 billion minutes of consumption last year. That is more than the next 20 top primetime shows in aggregate. Think about that.
Wow.
70% of Yankee games are rated #1 in primetime. Right? Now, if
so much for the death of baseball, huh?
Well, it's interesting. You know, we always said that, you know, and again, it's unique to the Yankees in this market.
Sure.
It's unique to the Red Sox in their market. And that is some of the best must-carry content in those markets. Opening day is tomorrow, and you're going to see the two of them. That's going to have tremendous ratings. And so, you know, I think that what you're going to see is the cable bundle will stay intact. It's the one place from a value proposition to the consumer, cord cutting or not, it's the one place where you can get, you know, a grouping of sports content. The streamers will look to come into this space, and they are coming into this space. You mentioned Amazon and Thursday Night Football, but it's going to be hard for the streamers to put together that portfolio of sports content the way the cable bundle can do. Right. And so you'll see a combination. You'll see, you know, the benefit of the streamers is that they will attract a younger demographic to some of these sports. There will be an a la carte nature to it, but at the end of the day, nothing. I don't see anything that is going to replace that cable bundle in terms of that portfolio of sports content for the consumer.
Right. You know, one of the other interesting things that feels investable, and certainly you've been involved in, you mentioned Spring Hill, and for those who don't know, Spring Hill Company is the combination of several companies that were started by LeBron James and his business partner, Maverick Carter. As you mentioned, it is a culture company. They produce a lot of media. They do, you know, some sponsored content. It's an amazing platform in many ways. LeBron, in many ways, one of one, except he does represent this investable athlete concept in some way. And you've talked before about the IP of an athlete, the intellectual property around an athlete. Help us understand how that's evolved and maybe where it's going and how you think of it as an investor.
Yeah, look, I mean, you know, there's a great fragmentation going on in sports and media and now culture, and individuals are becoming IP in and of themselves. Now, you know, a few years ago, we created a company in partnership with the collective players in the NFL Players Association, Major League Baseball Players Association, called One Team Partners, that aggregated the collective licensing revenues for the Madden football video game, the Sony baseball game, and that was before and leading right into name, image, and likeness, NFTs, blockchain. All of that is a fragmentation of monetization of individuals. Individuals are becoming more IP in and of themselves.
Yeah.
And that's a good thing. You know, what everyone is scrambling to catch up on is how do you monetize that? There's no playbook for that. But there's no doubt when you look at, we were talking about, you know, whether Tiger Woods plays in the Masters, you know, what do you think is going to happen to ratings for the Masters if he ends up playing? You know, that's a positive. Capital, you know, partnering with individuals and helping them monetize their IP is something that fascinates me.
Yeah.
You know, our partnership with Dwayne and Danny on the XFL is about building a league. It's also about giving them a platform to monetize some of their IP in a very different way. Same with Maverick and LeBron.
Yeah. I mean, I dare say that it's interesting to, again, sort of synthesize some things you're saying. You talk about sort of the importance of representation at the very top level with Dwayne and Danny that comes and has a real social and cultural impact. By the same token, at least in theory, from an NIL perspective, when you have a Paige Beckers or another college athlete who's able to monetize her or his likeness, there are some minefields for sure, but some real economic opportunity from both an individual and maybe a collective effort. Do you agree?
Yeah, there is a huge responsibility that the breakout individuals have to their ecosystem. And so, a Tom Brady or a Tiger Woods or a Peyton Manning, they know it. They know they have a responsibility to, monetize their own IP in a responsible way, but also do it such that it inures to the benefit of the ecosystem.
Right.
That playoff's going to be very interesting, and how the rules evolve. You talked about college. I mean, that is a very tough area, right? Because it's that, but there's no doubt that forget about college. How about going down to high school?
Right.
And there's no doubt our kind of capital is not only looking at college; it's now starting to look at sports in high school. There's going to be a lot of cautionary things that you're going to want to put around that. But it starts with the pros, and the pros need to set the template and the responsible way of doing it, and then see if there's iterations of that can go down to college and to high school.
So as we think about this ecosystem, there are all these sort of seemingly ancillary, but certainly integrated elements that are in, whether it is technology, fan engagement, sports betting, all sorts of media plays as well. What most excites you from an investable perspective, especially for an audience of investors who are saying, well, I want to dip my toe into the sports world more broadly? What's the play here, do you think?
I'd love to give you a soundbite answer. In the old days, I remember 5 years ago, everybody kept saying that the next frontier was China.
Right.
And they always talk about China with the NBA. I've got a very unsexy answer. It's the stuff that's here.
Yeah.
Version 2.0 of the stuff that here is what excites me the most.
Interesting.
These were hobbies, and they're now multinational live event entertainment companies. Nobody has figured out how to monetize the live event. I've nibbled around the edges, but no one knows how to do it. It's very difficult, but it is the best must-carry content in any area. The ratings speak for themselves. What's fascinating is because of technology disintermediation, the fan is taking on a different role that is going to drive version 2.0. The fan is going to be much more interactive. And the owners of leagues and the owners of teams are going to have to re-underwrite the value proposition to the fan, and it's going to need to take into account that interactivity. That touches the flywheel of gambling and data analytics and all the things that you mentioned, and that's what excites me. So at the end of the day, owning rights is the hub to the spokes wheel. And that's why, going back to your earlier question, that's why you're seeing this escalation in these valuations. We may not be able to analytically substantiate these valuations as the way I would like to, the way I've been trained, with real research and everything else. But I will tell you, when you step back and you look at that and you bring a 30-year perspective to it, there's a reason why these valuations are escalating.
Yeah. Any cautionary tale here? What's your bit of pump the brakes?
The pump the brakes is what I said earlier, which is things don't always go up. And our young generation and a lot of the young people who work for me, they've only experienced something that, as I said, is anti-Darwinian.
Yeah.
And now sports. I've been on the record saying sports a little bit is like the new Hollywood, and so capital is doing what capitalism does, right? It's finding its way into these areas, and I think if anything, I think everything needs to just calm down a little bit.
Right.
That's the caution I would say. It's all legitimate. Everything we've talked about, there's real terminal value in the basis of it, but there's a tremendous amount of capital sloshing around, and it's very difficult for people to get exposure. People in this audience to get exposure to sports. How would you get exposure to sports? People are trying to figure out how to do that, and I'd say that it's tricky because. You'd want your capital going to work where you have a seat at the table, where you have an ability to exercise governance, where you want to be able to be a fiduciary to drive when you might want to exit or not. Very difficult to do that in sports.
Yeah.
And it's a closed ecosystem. And so I think capital has to look at some of those attributes that we look at in the corporate world. All that stuff I just said, in the corporate world, that's a given. In sports, people are paying control premium valuations for minority stakes with no ability to get out and no governance. Well, that you might want to look at that and say, well, wait a minute, how's that going to go?
Right. Well, unfortunately, we're going to have to leave it there. We'll continue this conversation over cocktails. I'm going to thank you before I tell you what to do next. This was fun. Thank you for doing this. Really appreciate it. All right. All right, so that's a wrap, but don't go anywhere yet. I have some things to say. Thank you to our founding sponsor, BNY Mellon Wealth Management. Thank you to our presenting sponsors, Grayscale and LinkedIn Sales Solutions. You saw their logo on your coffee. And thank you to our amazing speakers like Jerry and many others. And of course to you, it was really nice to see you in person. Please continue to engage with us on social media. Use the hashtag Bloomberg Wealth and on Twitter at Bloomberg Live. To watch any part of this event again, and who wouldn't want to, you can view on demand at BloombergLive.com and the Bloomberg Live YouTube channel. We have more Bloomberg Live events coming up very soon. April 13th up in Boston for our Intelligent Automation Briefing. April 27th right here in New York for the Bloomberg Green Summit. And my personal favorite, May 6th down in Miami ahead of the big F1 race for our next Power Players Summit. For more details, go to BloombergLive.com. Let's go have a drink. Thanks so much.